Good evening and welcome to Position Sizing, my take on the markets. It's Sunday, November 14, 2010, and before we begin, I caution you to invest at your own risk. I don't share in your profits, so I don't share in your losses. Today I want to talk about where to start money flow teas. For more information generally on money flow teas, please see the video I made on October 13. Also, for the rules on where to place the center post on money flow teas, please see the video I made earlier today. Before we discuss the rules on where to start money flow teas, please keep the following two concepts in mind. There can only be one starting point that accurately forecasts the end of the trend, and two, depending on the structure of the chart, there may be alternative starting points that accurately forecast dates where interim support or resistance can be expected. So here are the rules on where to start the money flow T in order to forecast the end of the trend. If there is one clear single top or bottom in price, start the T at that price extreme unless there is divergence between the money flow and the price extreme. If there is divergence, then start the T at the split of the divergence pattern. Here's a couple of examples on split divergence. We're looking at a chart of the S&P 500 in 2001. You can see that price peaked on the week of January 29, but the money flow made a slightly higher high the week prior to that, January 22nd. So if we split that divergence, we come up with the right answer. Here's another example, the S&P in 2010. Notice the price peaked on April 26th, however money flow peaked on March 17. If you split that divergence pattern to start your T, and of course placing the center post at the week of May 17, you would have projected an end date to that down move of July the 8th, which was only a couple of days late. The next rule for forecasting the end of a trend with money flow teas is this. If you're starting with a multiple top or bottom pattern, use the first top or bottom in price to start the T. Here we're looking at TLT, the Treasury bonds. You'll notice it was a triple bottom pattern, but we get the right answer only if we use the first bottom. Here's another example with the Dow 2002 to 2004 time frame. You can see we could have started the T in March of 2003, but we get the right result if we use the first bottom in October of 2002. The final rule for forecasting the end of a trend is that if the trend started from a breakout of a consolidation pattern, use the breakout date as your starting point. Here we are looking at the 2008 low in the S&P, broke out of a consolidation pattern August 29, money flow peak at October 10, projected a move end date of November 20. Unfortunately, I'm running out of time on this video, but here's the rule for alternative starting dates. If you're faced with multiple tops or bottoms, you have the opportunity to forecast expected dates of interim support or resistance by using the last top or bottom, or by splitting the first and last top or bottom. But be aware that these forecasts of interim resistance and support are far more unreliable than forecasting the end of the trend with the money flow teas. That's it for today. Until next time, happy trading.